We don't normally.
I'll record this meeting as well, just in case I need to go back to it. Okay, let me take a photo. If you can show your ID next to you on your left, I will take a photo. Be cool. Get a bit closer. Bring the eye license real close. A little bit higher. A little bit. Yeah. Okay. Fine. Good. Thank you. Done. Yeah. Good. Hi, Lisa.
Hi. How are you? Nice to meet you.
Nice to meet you. How are you?
Good. Thank you.
Good. Now, if you might, could you show your driver's license or passport next to you? Just let's get this ID checked down first. Fantastic. Great. Thank you. Done. All good. Now, I don't want to spend too much time with it's night time. I'll show my screen. Okay. I think maybe it should be right. Can you see this screen? This is a spreadsheet.
Yes, we can. We got two screens so we can see it.
Yes.
Yep. Got two screens. Okay. So can you see the current? Can you see this one? I want to, because for some reason I can't see the screen I shared. Which screens do you? What information can you see?
Doing finance only screen. Does that mean anything up top?
So I'm not sure what you're seeing. Yeah, we've got two screens. So we see yourself and us on one screen and the spreadsheet on the other. Okay,
let's see. In this, for example, in the spreadsheet, this spreadsheet is my. I put all information into this spreadsheet. Can you see FM? Can you see all the values of your properties?
Yes, we can see it.
You see, right? Okay, cool. Yeah. So these value are estimated using core logic. Now, this account number in this column is the account loan number from First Mac, and this is the current loan balance, 95,000, 97,000, 432,000. And then that's the interest rate you are paying based according to the statement. 3.23, 3.78, and the last column is the current repayment. The total repayment with First Mac is $4,128 per month at the moment. Yeah. And total loan balance is 1.236 million. Yeah. And I think total value. Okay. Now, what I think, so if we want to refinance, there's some parameters we need to meet. For example, we want to control LVR, loan to value ratio, under 70%, so you can get the best possible interest rate with Westpac. That 70% LVR, including your two properties currently with Westpac, which is Elm City Circuit and Urana Road. Right? These two properties are with Westpac at the moment. Yeah, and if we add the remaining property into the Westpac, your total value will be over 3.3 million. Will be more, but let me go. Yeah, will be less. Let me go back to that. And total loan amount with your existing Westpac loan plus the potential new loan will be 2,258,000. So the overall LVR, loan to value ratio, will be 61%, with way under 70%, which is good. So we can get the best interest rates. from the Westpac. However, because I think if these numbers stacked up, and we don't need Wilkinson Street as a security. So that $250,000 property, we don't need that property. We can just, after this refinance, you can remove this property from mortgage. So you can take as unencumbered. So that's why I think that's a proposed structure as equity structure. First property will be line, that's your home, is around 700,000. Union Road, 450, and Bamford Road, Bamford Street is 450. The total, and plus 2 existing properties with Westpac, the total value is 3.1 million. Total loan amount still remains same, 2,058,000. The LVR will be 66%, still under 70%. So out of this transaction, you have one property on Wilkinson circuits or Wilkinson Street, Wilkinson Street without mortgage. So basically, you can say this loan is paid off in this property. Yeah. So.
Okay, what would be the advantage of paying that off? Because it's a appreciating debt and a tax write-off. Wouldn't
No, it's not paid out. It's not paid out. It's just the loan is still there. So the Wilkinson Street, the loan is 188,000. Yeah, 188,000. The loan is still here. I simply moved the loan under Line Street.
Okay, why would we do that? Because we want to be able to pay our house off. We don't want any cross collateralization. Okay.
Yeah, if you want to do that, it's okay. Then we can leave this Wilkinson Street in the picture. That's not a problem at all. I thought just try to, generally speaking, we recommend give bank as little security as possible. There's no point to give them more than required. But if you want to secure this 188,000 against Wilkinson Street, is okay. We can add this property to
the other one that I see, to jump in, is the unit 12. I know it is only listed once. Yeah, it does have 2 loans. Okay, no, and down lower it's.
Yeah, there's a Bamford Street, right? Yeah, the Bamford is Bamford Street, Bamford Road. Bamford Road is still 2 loans. 2 loans against Bamford Road. Yeah. 1 loan against the Union Road, and but we can put oops, sorry. We can put Wilkin Street back to here. Yeah, that's not a problem. Leave it out or put it in. That doesn't matter at all.
Yeah, we don't want to tie it. We don't want to tie it in. We want flexibility now. That if we decide to change something, then we can. Now we don't have the repayments from the Westpac.
No, we do. That's something we need to play around. Play around. Now, and also get back to cash out. It is also possible to get a $6,000 cash out if we launch the application by the end of this month. Mm-hmm. And $2,000, which is if we put at these 3 loans together, is about 280,000, more than 280,000. So this meets the requirement for 250,000. You can $2,000, $432,000 for against Union. We get 2,000. And again, this is 424,000. Again, we get $2,000. So together, cashback will be 6,000. It can be done. Can be done. Now, that's the repayment thing. Now, okay, current repayment 4,100, right? And that's the interest rates. That's the interest rate under 70%. Already, the discount is already taken care of.
Mhm.
And I also negotiate the variable rate with Westpac as well. Okay, go back to the Line Street, 95,000, 98,000.
Yeah, the reason for the two loans was so that we could have two offset accounts. So really, they're obviously the same loan, but
Yeah,
same property. Yeah.
yeah. I will consider these two loans as unoccupied purpose, even though this loan is for investment. These two loans are for investment purpose, right?
The two loans.
Yeah, 95 and 98,000.
No, it was just for us to be able to have two separate savings accounts that affected the offset. So if we'd only had one loan with them, we would have had to have our funds and rental funds on one account. So there was no extra cost to us, and they just said, "Yeah, we'll give you two loans, two offset accounts, and that way we can." It's more for our own tracking, and I suppose for the accountant. Yeah. Whenever we spend something on a rental, it comes out of that offset. Whenever we spend something of ours, it comes out of that offset.
Yeah,
neither is for investment. It's all our money.
Yeah,
just for our accounting purposes.
Yeah, we can keep the exact same structure as you have with the first Mac. So keep 1, 2, 3, 4, 6 loans, six separate loans, and for each of these two loans, you can link to in a separate offset account as well. So exact same structure. Now, my question is, these 97 and 95 and $98,000 loans, two loans, they are for the purpose of investment, right? It's not for your personal use.
No, it is definitely our own money. It's our savings, and it's offset against our own property.
No, I'm talking to the loan, not the offset account.
Oh, sorry, the loans.
Yeah.
No, the two loans against Line Street are against Line Street.
It's for your personal use, personal with home loan, not for
totally
investment.
personal.
That's good. Okay. Yeah, that's good. Now, so for these two loans, we'll consider as an unoccupied home loan, the interest rate will be 2.39%. Principal plus interest with offset account. Yeah, so this you can see the two loans, 95, 98, PNI, variable rate 2.39, 2.39. That's the repayment for suppose on 30-year term. And again, we take 30-year term. We don't reduce a long term, right? It's still 30-year.
Yeah, there's no need to, because we won't be paying it out in that way in that time. We'll be paying it out when we either pay it out or sell it. So
yeah. Okay, good. Now for 188,000, potentially we can consider as using 1.89%. It is a 2-year fix, 1.89%. We can also do that. It is basically it is a home loan interest rate, but I can use that rate for investing purpose. 1.89%, 2-year if you take a 2-year fix. I presume the rate. So for this investment loan, 4 loans, you want to take a variable rate or fixed rate?
Look, it depends on what works best for us. So I suppose we're looking at making sure that our savings goes up so we can pay down various loans when we want to, but always making sure that we can pay out our own home with our savings and everything whenever we want to. So that's paying our own home, having the flexibility with our own is very important.
That's priority. And your home loan is about 200,000. 193,000. How far away you think you can pay it off?
Well, we've got $240,000 savings.
You can pay off anytime, virtually.
That's it, and that sits in the offset savings accounts.
Yeah.
So in effect, we are paying no interest on our own home.
Home loan.
We are paying it off at the rate that they want us to, which is the
Yeah.
principal only, because we're not paying interest. And just when we decide to do it, we will either pay it out or sell, one or the other. You know,
Now, how much money you can save up every year after paying this mortgage,
Surely,
after paying minimum repayment, after expense? So how much money you can keep accumulated in offset account?
I'm not actually sure. Our tax returns, we've got a couple of years due. We haven't been great on them. We kind of get about, we've only got 1 year, haven't we? Just about 2.
On the 30th.
We've just about got 2 years. So next month we'll have 2 tax returns due. We've kind of got $10,000 to $12,000 a year back on that. So that automatically goes into
Offset
our
account.
funds, because that's what it is.
Yeah. 20.
And the other, look, I'd have to look at what we have actually saved over the year. It's probably something we haven't tracked, is how much money it increases.
Yeah.
I don't know, 5 years ago, it was, what do you reckon it was 5 years ago? Under 5 years, it was guessing under 100,000 between the 2 accounts. Now we're up to about 240. We did sell a caravan in the time, but that was only 20,000.
So over 5 years, about 120,000.
Yeah, look there. Yeah.
So it'll be 20 to 30,000 a year.
Possibly, yeah. That spreadsheet I sent you a screenshot of.
Yeah.
My rough figures, we should have a surplus of about 24,000. I think was what I'd worked out.
Yeah.
So if we add tax, that's 35,000+ a year.
Yeah.
It's probably what we would save.
Yeah, you have a 163 and 80,000 saving at the moment.
Yeah.
Yeah. So basically, your offset account is not working for you then, which means now you don't have
totally. It's not totally working for us.
Yeah.
It's saving us, even though
saving. Yeah. I think in that case, I would recommend to have at least $50,000. Now you already got 40 more. I think you should have $100,000 make $100,000 at least as a variable rate with another offset. I know it is for investment. However, if you don't pay interest, why not? I think
in your situation, purpose of that. What would be the purpose of that?
The purpose is you can save interest. For example, for this 100,000, again, this is one of the Banfer loan, 100,000. You pay interest at least 2.39% if you pay, interest only for a 2-year fix. However, if you have a $40,000 sitting in offset account, if you can offset the 40,000 against the 100,000, you only pay $60,000. You pay interest over $60,000 instead of 100,000. Right, and of course you have a less tax deduction. But
we lost you then.
Yeah, but you
sorry, we lost you then. We lost you for a short time.
Oh, okay. Better.
Yep, it's back now.
Better. Cool. Yeah. So I think you don't want to have offset accounts balance more than the variable rate loan.
No, we know that we need to fix up our loan because there's money sitting there doing very little. Yeah. So I think you should take this in this transaction, you need to change, and simply you can change from fixed interest rate to variable rate. Then you can link to offset account. I think this $100,000 it's a very, very good there. Just $100,000, it's just right. You have about $40,000 surplus already. This if we fix all the loans for 2 years,
in next 2 years, you should save about another 40,000 to 20,000 a year. So after 2 years, you have $80,000 sitting in offset account, pretty much offsets the majority of this $100,000 loan.
I know we get tax return back on interest, but it is only at whatever rate it's calculated, not on 100%.
Yeah.
Are you trying to offset, for us to work on offsetting the full interest on 100,000?
But yeah, for the taxation purpose, they don't calculate offset or whatever. They just calculate how much interest charge, right, from the bank statement. It's for this financial year, this loan interest charge is how much, so much. So you claim tax. If this loan is 100%, yes, if a loan is offset, they said this financial year interest charge is 0. That's it. They charge you 0, and then of course you don't claim tax. But it's better off, right? You save about 60%. The tax ratio is about 30%, 35%. But you save the rest. I think we should consider that. Make $100,000 as a variable instead of 2-year fix. Then you take advantage of your saving with offset. The loan structure is still same. This 100,000 is still against Benford Road. Still same. Just you don't pay interest, or you pay less interest. Yeah, we can do that. And again, I can set this rate as 2.335%, as 2.39%, same as this one as well. That's not a problem. Same as this. Let's tentatively do that. Again, we can always change that. Change and review and change. Okay. Now, yeah, so let's, and for the remaining 3 loans, 188. Now, let's go back to the interest rates. Interest rates. Now, for 2-year fixed rate, now we don't have unoccupied. Yeah, if it I don't know whether now let's take an investment rate. If you take a principal plus interest, the repayment at interest rate is 2.19%, principal plus interest. If interest only is 2.39%, the rate is slightly higher.
That type of discussion comes down to what it does to our total repayments.
Yeah.
So that's save as much if we pay more out.
Now
we go to principal and interest.
Yes, that's now this kind of conversation we need to discuss together with the services borrowing capacity as well. Can you see these comments here? Assessment rate. Yeah, assessment rate is the interest rate the bank calculates their nominal repayment when they calculate how much you can borrow money. They don't use this the interest you pay. Rather, for each product, they have a different assessment rate. So now for investment loan, principal plus interest repayment, the assessment rate is 2.84%. They use 2.84%.
The real rate that they do the thing to make sure that if there is a shift in interest rate, we can afford it.
Yeah, that's a base rate. It's assessment 2.84. However, if for investment interest only, the rate is 3.74. It's 0.9% higher. So which means if you take this option, everything same, you will borrow less because the calculation rate, interest rate is higher. So that will impact how much you can borrow. Of course, the repayment is higher. For example, if we take this option, interest only for three loans, interest rate for this loan, and I'll take this interest on principal plus interest. If we take interest only, the repayment will be lower. So the rate will be 2.39, 2.39. The majority of the rates are 2.39 to variable and interest only for investment 2-year fix. The repayment is $3,330.
And what's the repayment?
3,331.
That's at your proposed. What's our current repayments? You had that listed elsewhere.
4,128. It's about $800 less per month. However, that's for interest only. Yeah. But if we change to principal plus interest, so if we want to borrow more, the repayment will be here, will be 4,692. Is about $500 more, $550.
Yeah, so
500, so that $500 more. Now, so that bear this in mind. If for principal plus interest, repayment is higher. For interest only, repayment is lower. Now let's go back to another calculator, which is Westpac's loan servicing calculator. That's the important one. Let me go back to, let me share that screen. Where is that? Okay, here. Share this one. Share this one. Okay. Now, can you see the Westpac serviceability assessment calculator?
Yeah.
Yeah. Okay. Now, so this is the servicing calculator we use as well as bank uses. Exactly same calculation. So what it does is in the top part is the two applicants, you and Lisa, the applicant 1 and applicant 2, Lisa and Anthony, and first section is about your income. So that's if you go, that's your income. Your income is about $138,000 a year. That's your income. Yeah, $138,000 a year, and that's Anthony's income, and that's Lisa's income. About $46,800.
Have you put both Lisa's incomes in? Because don't forget, I said one we get pay slips for, the other we don't.
What do you mean by no pay? Don't means
we only get a payment summary at the end of the year. So
what's that? It's
$1,400 a quarter.
What's that? What's that income?
It's the same place, but they have an arrangement with them that they pay from 2 different areas.
There's 2 different job roles within the one position, and it does kind of make it difficult, but it is an always ongoing income. It has been there for many years, and it's just we don't get a pay slip for it.
I don't know whether we can they will use this or not, because usually
Other banks previously have. So,
but if we use it, probably you need to provide tax return as well to confirm that's it's ongoing. Last 2 years tax return.
we do have letters all the time that says it's ongoing. It's
Okay, yeah. You get a tax
have
return.
the tax summaries or the payment summary.
Per summary. Probably we can use that. But no, that's I'm not sure. Let's consider that's from Anthony, from you or from Lisa?
That's Lisa's.
That's for me.
For yours. Okay.
See, my income's actually 130, but I do get some very good tax benefits in there working for public health.
Yeah, I think that, yeah, that's why, because these this calculation, you see, is from a gross Y2D amount. This if your like allowance or this non-based income will factor into this Y2D figure. So that's why your income, the annualized income is about 138,000. It's all the we use all the figures in your payslip.
Mhm.
Yeah. Now, if Lisa, okay, Lisa, okay, if Lisa is 14,000.
It's about 14, isn't it? It shows on that thing.
1,400
Oh, 1,400.
quarter. Yeah.
1,400 a quarter.
Yes.
But they pay you once a year or every quarter.
Paid in quarterly, so it is in the statement.
Ah, that's fine.
Statement.
Okay. Yeah, that's fine. Quarterly income is okay. Yeah, quarterly, because they do have a, if you look this, it do have a quarterly payment, you know? Yeah, it's fine. 14
If you
so
want. I can get my phone and look it up if you want.
yeah, that's fine. That's fine. Let's presume you paid for a whole year, and quarterly is this two. We can't have a future date. So it's 1,400, right?
Yeah, 1,400 and something.
Yeah, let's say 1,400. It's a 1,400 gross. And we paid 4 times, will be 6,400 a year.
That's a net. That's what reaches the bank.
Oh, that's a net. Okay, net. Taxable, no, net. Okay, if a net, probably I would say I'll make it.
That hasn't changed.
Make a 16,000 and make about 7,000 as a gross. Just okay. Just do this. Just presume. You know, should be. Now it's better now.
Payments,
it's better.
Yeah.
Yeah, it's better.
9,200 for gross payment a year.
Gross or net?
Gross. We just found the payment summary from last year.
For how much?
9,200.
Oh, okay. 9,200 divided by 4 will be 2,300. Yeah.
So that's gross. Yep. We're putting in that. Yep.
Yeah. That's good. Yeah. Okay. If you keep the record of this quarterly payments, right?
Goes into the tax every year. It goes into the ATO, and
yeah, that's fine. Yeah, that's fine. It's fine. Yeah. Okay. I think that's much better now. That's still a little bit shortful, but much better. Okay, let's get to the other areas. So now, no dependent. That's what a postcode.
Else. Yep. No dependents living.
No dependents. No pets. Probably pets.
Yes.
Yeah, and the living expenses. You know, I just do nominal living expenses, but they use HAM, but we don't need to go down to here. Now, this is rental income. That's all your investment properties. 5 investment property. All the properties are 50-50 share ownership.
Elmsley is only in my name, but the debt is in both names.
Oh, all the properties under your name.
No, only Elmsley is under my name. All the others are 50-50.
Which ones? Okay.
But the debt.
Yeah, the debt. All the mortgages are under both names.
Yeah. So Elmsley is under your name.
Yes. Yeah, it's from a previous marriage. So
yeah, that's fine. That's fine. So, but the other 4 are 50-50 share.
yes.
Okay. Yeah. So the rent, that's all the rental incomes for these 5 properties, all weekly. Yeah. Okay, that's cool. And that is the that because I took out the Wilkinson. Okay, Wilkinson 188. Which one
Yeah, that's 50-50. It's the top one, Elmsley, that's 100 mine.
Yeah. Okay, this is a presume. Let's make it 2.39% as well. So that's the tax negative gearing calculation. That's the actual interest rate you are paying. This because these first two loans are existing with Westpac. The rate is 3.99. Yeah, and these three loans, three properties, I'll presume 2.39. These rates are in interest only rate. Interest only. So they calculate negative gearing based on loan amount and the rate, the actual rate. Okay. Now this 750 is the Anthony's share of the property investment property cost, like a council rate notice, whatever cost. I estimate about 1,500 per month across all the properties. Okay, now so these are same because the only change is 0%. Every entitlement, everything same. Because once we're done in one applicant, all the information is populated to a second applicant, so which is nice. Okay. Okay. Now, those are the interest, the loans we are talking about. Let's say 2.39 or 2.59. This is also 2.39. No, sorry. There will be 2.774. Sorry, it's my mistake. 2.74 because it's now we need to decide whether we want to take interest only or now. These two loans are interest only
already.
Yeah, we want to take interest only. And for we concern, you can decide whether to take interest only or not. If interest only will be, oh, sorry. This rate is not, this final rate is, if you take interest only, it will be 3.84, 3.894. Let's go back to the other calculator. 3.74. Remember, this assessment rate is higher, right? So this is assessment rate, 3.74, 3.74. So these two loans are interest only. This 100,000 is a variable. You can decide whether to take interest only or principal plus interest. And this, do you know what I mean? If you want to take interest only, you need to use 3.74 as a final rate. If you take principal plus interest, will be 2.84. Right. So the outcome is different. Now we have a minus $800. Yeah, $800. Now we have two credit cards, 7,400 with Westpac and 12,000 with Coles. So this is the minimum, the nominal repayment is calculated, 281,456. So that's a common situation. So if you take interest only, we are short about $802. Means we need to either reduce the credit card limit or we need to reduce the loan amount. For example, if you will take this loan, it now is 324, right? If you make it 200,000, 224, so less, $100 less. Let's see how it goes. That becomes 171 short. That so that's how we. So we need to muck around basically, or if you take principal plus interest, it will be 2.84 instead of 3.74. They will be short on 377.
I suppose that the repayments are important, that we don't change our savings progression increase.
Yeah. How much? Say if you pay $500 more a month, it's about $600 a year, right? Now let's have a look how much you can save in interest. Can you see this spreadsheet, Anthony?
We've still got the calculator.
Still calculator. Okay, let me. I need to change. I need to change the share. Okay.
What Dennis is saying is, if we pay more out, we'll pay less in our savings, but we'll be paying more.
Yeah, less in saving, but you save on cost.
But
That's
we're probably never going to pay these out. Our home we will, but the investment ones, while ever there's a tax, the plan is to keep on borrowing into them over time until we pay them down a fair bit. We probably won't reach the stage of being able to live off the rental income unless we own them all. Now, at our age, we're probably not likely to own them all before we're too old to appreciate it.
Yeah, we'll just sell a couple.
So we would be selling and borrowing in to some and selling others. As we progress through our lessening need for money as we age.
Yeah.
So that's something we don't have a calculator for and are not definite on how to calculate.
Yeah.
That's
yes,
I
agree. Far. Yeah, I agree.
So saving interest is probably, on investments is probably not a great advantage over 30 years. And that's why we've got to probably look more so at what our cash flow is now, as opposed to saving over the 30 years. I think that's how my head works it out.
Well, how can we
so you were looking at that calculator, or if we do lower the credit card limits, what does that do to our borrowing ability?
Yeah, let's have a look. Let's go back to this calculator. Is it this one?
Because it is only for 1 or 2 months. I'm sure that we can work something out. We can also play with having more at P&I, but not all of them.
Let's go back to this. No, not 87774. Yeah. Okay, will be these 3 loans are interest only. They were short $802. But if we cancel both cards, it will be $700. We're still short, even we cancel them.
Well, that's a weekly repayment, is it? Not a monthly.
That's a monthly. That's a what they calculate is a 3.8% over credit card limit. They consider as a monthly repayment. So if you have a $10,000 cash credit card, they suppose the repayment will be $380 per month. So that's how they calculate. So this, so that's how the minimum repayment. So that's why these numbers are here. So
can we go back to the other spreadsheet and work out how to come close to our current repayments? With
which one?
P&I.
P&I.
Or is that, yeah, because it's the affordability. We have to be careful with the affordability. We hadn't actually thought about increasing our repayments.
Increasing your repayment. Give me a second. Let me share this one. Increasing your repayment. What do you mean increasing your repayment?
By changing more to P&I. So that.
Which one? Which loan are you considering?
The line you're on at the moment.
Line is a P&I.
Row 36, where you've got repayment at 3331 or 4692.
Yeah, that's on interest only. 6492 is on interest only.
Or P&I.
No interest. Oh, P&I. Sorry, P&I.
Yeah, and the other one's a mixture of P&I and interest only.
Interest only. Yes. Yes.
If we were to say change union up to P&I as well, what would that do to
P&I 2 point? Let's do this. P&I would be 2.19. 2.19. Now the repayment will be a little bit higher. That's a P&I repayment. P&I repayment. So this 4,109 is close to your current repayment. Yeah. Now let's go.
Put the last one onto P&I. We seem to jump a lot.
Yeah. Yeah. It is. If it's interest only. So this one interest only calculation. $788 interest only. But if you change to P&I, will be 1,638. Yeah, it's a jump a lot. It is. Yeah.
That's the type of figures that we just couldn't possibly work out to fit that other calculator as to how we.
Yeah, so we need to find a trade-off and between repayment and borrowing capacity. Yeah, so that's the key benefit for this finance is the interest rate reduction. Looking at all these three over three. Now it's all under 2.4. It's about 1% reduction. However, let's just bear in mind, Anthony, when this fixed rate loan, when this
interest only period.
Yeah, first MAC interest only loan expires.
They will go up, yes, but then we would probably look at renegotiating back into.
That will be difficult if you want to roll to another interest only loan term. They will do similar assessment again. They can't just roll to another interest only. They will assess. I think at that time you may find difficulty to roll into another interest only term. I think you may need to force into P&I.
Made it very difficult for a while there, but I thought they'd lessened.
No, because
forcing everybody onto P&I off interest only, and then the government maybe realised their mistake.
Yeah, but I don't know, because so how long have you been with this first MAC for this interest only loan?
2018, whenever we bought Benfa.
Okay, 2018 will be 3 years.
2018, I think that was, yeah.
3 years. So you set interest only for 5 years?
It would have. I can't remember. Yeah.
Those 3
I
years.
did give you all the figures on that as to when they come out of it.
Yeah, 3 years to go. 3 years to go. No, 2 years to go. 2 years to go. But after 2 years, I think it will be difficult. Will be difficult. Same as because if this 2 year fixed interest only expires, if you roll to another interest, when the interest only term expires, they will reassess your loan. If it's PNI, they don't. They just roll to whatever product you want. But once the new loan, if you roll to or keep as interest only, they have to reassess. Yeah, that's another factor you need to. So which means it's likely that repayment is not permanent. It's not. It won't be permanent. It's still, you know, because there's a term, interest only term.
Yeah, look, we'll have to have a thing, because I'm just, the $6,000 a year less savings. I'm just wondering where that gets us, because as we said, we don't really plan to pay them all out eventually.
Yeah,
but
I think but in reality, Anthony, you will need to, because in the end, in next 2 or 3 years, you can't have this interest only loan anymore. It's unless you reduce your loan by sell 1 or 2 properties. Otherwise, you can't have it. Surely, it is not possible, because remember, this at the moment interest rates are low now, but in 2 years' time, the interest rate will be higher.
Yes.
Yes, borrowing capacity will be worse. So, yeah.
I suppose in the meantime, that's why we've got to get our savings up and be prepared, ready to pay, and have, pay our place off and have a buffer still. Yeah.
Now I think that paying off your property is not an issue, because you already paid it off virtually. Technically, it's already paid off. Yeah. Now again, this exercise gives you $6,000. Now, probably you need to pay about, say, $2,000 cost for refinance, but you still have a net about $3 to $4 grand in your pocket. You can consider as that 3 to 4 grand is your added on to your saving as well. Yeah, I think we need to have a play around, and also that 30th of June, this offer will stop. It will be replaced by $3,000 cash, $3,000 refinance, cashback, no matter how many applications, how many properties, just $3,000 flat.
Okay.
Yeah.
Because that's nice, getting $6,000 back, but it's probably not the real reason that we want to do it. That's a one-off payment. So it's got to be affordable for the next few years and make sense over the next few years. Yeah, so basically, with this exercise, you have to pay down some loans virtually slowly. Yeah, it's not a keep interest only. Yeah, otherwise you can't. So if we refinance as per your all P&I and we get this $6,000 back, that covers the first year of change, but not ongoing after that. Yeah. No, you can't keep $600 altogether in total, because you need to. There's a cost for refinancing. You are talking about how many properties? 4 properties. Refinance 4 properties. 4 properties. In New South Wales. In New South Wales is about $700 per property. I thought our package with Westpac The
No,
325.
no, it's not. Westpac doesn't charge. For First Mac, they will charge you discharge fee, around $350 per property, and the government in New South Wales they charge about $220 per property. That's Westpac doesn't charge at all. The Westpac doesn't charge, but those are First Mac and government. Usually in New South Wales, it's just under 700 per property. Queensland is about 580 something per property. So we have 3 New South Wales properties and 1 Queensland property. We're talking about close to $3,000 for refinance cost.
You've always got to weigh up that it's not the paying it off in the long run that's probably the important. Yes, we do want to pay it down, pay them all down, but as I said, we're not going to pay them off. Definitely not all of them. I don't think we'll pay all of them off ever.
But no, that's my view. I have several investment property as well. If I pay it down, it pay down slowly. The only disadvantage is you get less tax deduction, right? Because the principal goes into a property, it increases your equity. Equity is when the property going up, value goes up, increase your equity. The balance reduction is also adding on your equity. Paying down the home mortgage investment loan, the only downside is you have less money to pay down your home loan, right? However, in your situation, you don't have this downside because you don't have home loan. So I would rather pay down this investment loans, increase my equity. One day when you want to sell, you realize more value. Because there's no point to pay high rate just because keep the money in your offset account. But your offset account, there's no home loan to offset, and and you don't necessarily need this money. I would rather adding into equity. At the same time, I pay less interest. That's my thinking. If you have a $200,000 home loan to pay, that will be the arguments will be different. I would rather pay down home loans. Yeah. So in different stage, the reasoning can be different. Bless you, Lisa.
Yeah, I just don't know that last answer of which way is better going.
Yeah, I think you should take principal plus interest. You should start to pay down your investment loan. You reach this stage. You should say one day first, for the sake of discussion, do you prefer Wilkinson property? The loan is paid out. There's no loan. Paid out 100%. You own 100%. Of course, you want to that.
But I just don't see it happening because of the way you structure.
Yeah, it's not happening now. But if you, for example, at the moment you owe 188, but in next year, if you say I only owe 120, it's better. You're better off.
I don't know if that would happen in a year.
Doesn't matter. Doesn't matter, but it's the less the better, right? The less the better. But with the principal plus interest repayment, it will be the loan will be less. It's not it won't be dramatically less. However, it's getting less. And on the way, you save interest. You're adding equity in your property. I think that's better To be honest, I'm not saying pushing you to refinance. No, I'm not in this kind of business. I think, honestly, it is better for you to take principal plus interest, pay less interest, and put money back into the equity. I think you should consider that. Or you can talk to your accountant or financial planner even. Just ask their advice. In this kind of situation, structure is usually in the early stage when people have home loans as well as investment loans. They want to use tax deduction to help them to pay off their home loan faster, quicker. But you already passed this stage.
You're in the consolidation and the next stage of it all.
Yeah.
No, I'm just while we've got Dennis, I want to try and think of questions of. Okay.
Dennis, I'll leave you with Anthony.
Okay.
Thank you very much for your time.
No problem. You're welcome, Lisa.
Yeah, it's the one part that I just can't work out is if we spend.
Now, first of all, I don't think you have difficulty to make the repayment, say 4,700, because if the bank calculates you can afford to borrow, definitely you can, because they use high living expenses. They use much high. Their calculation rate is 5.04%. So I don't think you have problem to make the payment. The only issue is not you want to pay less, but the cost is high rate, and you want to put it this way, you want to put money in offset account rather than put into the equity, into property. Right. So basically, that's
until we're advised otherwise. That was kind of always maintaining that buffer and the ability for us to pay our house was.
Yeah, but the problem is house is already paid out, Anthony. You already achieved this result already.
No, yes, I've already. So
yeah, you already so. It's not. Yeah, you see my. So for this exercise, you can even pay out these two loans. You don't need these line straight loans at all.
Would that change our calculation if we did say have no debt here?
It will change. Definitely it will change. Let me go back. Calculator here. For example, if 0, $240 surplus now.
And that's looking at their worst case, isn't it? They're excessive. So if we put them all, if all the others at P&I, where does that leave us?
Oh, that'll be. You mean you keep this? Keep this?
No, not keep those.
You pay out this. And then change to P&I. Why? Then you don't need to.
What does that do with our repayments? Sorry,
spreadsheet. Okay. Repayments will be less. Repayments. This one, right? Repayments. Where's the 90,000 is 0. Okay, repayment 3,940. It's all P&I.
So that's under what we're doing, and that's all P&I.
Yeah. And you don't pay, and you don't have home loans. But however, this one can reduce your cashback though. That's just a warning. Okay, wait, it's okay. I can still manage it. I can still manage it. I can still manage it because 180 and this is $100,000. I can play around with that. That's fine.
So, and all that does is leave us with about 40,000 in the bank at the moment.
Yeah.
With us having 2 years worth of tax to do very shortly.
Yeah.
Okay, that's something we've probably got to talk about. Now, what of this working sheet can you give us?
You can I can email working to you. But what you can what you do, you don't change this to I just marked them. You don't change this to you can change, but just these two columns, these are calculated, these columns. But when you do calculation, just be careful. You will try to use there's only two calculations. One is PNI. If a PNI is using PMT function, right? It's PNI. Okay, the function. If it's interest only, it's simply interest only, interest rate times loan amount divided by 12. That's very simple. This is just, there's only two calculations. Yeah, everything else, those are sum, the total. No, you don't try to, you can play around with this spreadsheet. Sheet 2 is for this. Sheet 1 is my, in the beginning when I have initial analysis, that's their current in a couple of weeks ago.
And you're also assuming estimation like their book valuations, aren't they? They're not.
I think should be close.
Should be close, yeah, because our house is often quite difficult because of it's unique, reasonably unique in the area. Our home.
Oh, yeah.
Because it's a big block just outside of town and quite different to a lot of the others in our postcode. So our postcode has a very interesting mix.
Okay.
Housing commission, government owned.
Yeah.
Up to some that are worth a couple of million.
Oh, okay.
So the postcode is very difficult to go by.
That's fine. But if you don't want, if you want to keep, if you want to pay out these loans, and we don't need this line street property.
But then what does that do to our
LVR? Okay. LVR can be will be over 70%. Yeah, probably we can leave it. We can leave this property, but leave it. It doesn't matter. We just use,
but no debt against it.
Yes. Just for calculation purpose. And also it's safer to keep your title certificate with the bank. You don't need to worry about that piece of paper. So
I don't actually understand that bit that you just said about leaving that.
Yeah, because if you pay out your loan, right, and the government will send you a title of certificate. The certificate of title, it's a certificate, and you need to keep it. Next time when if you want to sell, if you do anything, you need to produce the piece of paper, right? You hold it. It's your responsibility to hold this piece of paper. But if you have a mortgage, the bank holding this paper. So you don't need to worry about and keep it and put it in a safe place or whatever.
And if we leave it with the bank, we can still leave it. They don't own it, we own it obviously, but they just hold the bit of paper.
They hold paper, yeah.
And they have no hold over it otherwise?
They hold out the mortgage. But it doesn't matter. It doesn't cost you anything. You don't feel anything. Yeah.
Okay, I'm not really understanding that bit.
Because the bank lends you money, use your property as security. But again, this is say this if we take out this loan, right? So this is 70%, 70.38%. If any of these three properties valuation is slightly higher than these figures, then we can get 70%. Yeah. So we can.
And how would we find that out?
No, we can.
We
Yeah,
can,
we order valuation first. We always valuation first. Yeah, before we put application in. But even we put it back after we put it back application into system, we can still change it. We can still make changes to everything, to application, to loan amount, to property, security, value, everything. We can still make a change.
so by leaving the certificate with the bank, they do have a hold. If we were to go bust in some way, can they sell it out from underneath us?
Technically, yes. But they can't sell as they wish. They at least need to mitigate the situation with you first. They can't just because this loan falls into National Consumer Protection Act. The bank's hands are pretty much tied. They can't just sell whichever way they want because it's not a commercial loan. If it's a commercial loan, business loan, it's totally different. It will be it's not protected. But this loan, this kind of residential loan, is protected by NCCP. So it's of course the risk is always there.
Yeah.
You know the bottom line is as a mortgage they can sell your property. Yeah.
As long as they can cover whatever debt with the other properties, and they can't and wouldn't.
Yeah. It won't. Yeah. Yeah. For example, if only short they say 30,000, there's no point to selling property 700. You probably say, oh, let's sell the smaller ones. You know, as long as they can cover.
Yeah. Because I know the bank has a hold over the loans over the house anyway now. But it's kind of trying to move away from that as well. Yeah.
But again, if we can get the valuation slightly higher than 250, 450, then that's only 0.338%.
Yeah, Wilkinson won't come in I don't think Wilkinson will come in at 250.
Okay.
It's not a wonderful place. It's all right. Yeah, I think that I don't think they will come in that much higher. Ours probably would. But
what we can do, we can order valuation.
And what cost or what is involved in that?
No, nothing.
Nothing?
Nothing, because we have account with Westpac, with most of banks. They just charge us a yearly fee. That's all. They will cover that.
Actually, why did you choose Westpac?
$6,000 cashback.
Okay.
And also you have a loan with Westpac, and you just adding loan to the package. You don't need to pay additional package fee.
So that apart from the 6,000 cashback, they're not really that much better than the big four, the others in the big four?
Oh no, the rate is better.
The rate's better? Okay.
Yeah, you can't find 2.4, for example, 2.39% with any other banks.
Okay.
Yeah, Westpac is very, very aggressive in terms of pricing and offer.
So if we leave our property with the bank, then we're on easy street. And it's less repayments. Being P&I and variable, it means we can pay in more. We could continue paying what we were paying before, doesn't as well. So add another $100 into the payment per month.
Yeah. But I think, Anthony, you should have a second thought, whether you want to pay as less as possible or start to pay off your investment loans.
I do like the idea of P&I, but I also like the idea of our savings and so on. And doing it this way, we've probably met both those desires. In that it's all P&I, but our repayments are still lower. Yeah, it's just I don't know what that $500 a month does to our end plan. probably because I don't know totally what it is, because it's changing so much, you know, as it is, once we lose the ability to earn an income, we will lose the ability to pay back to the bank. And they may not want to lend money to us down the track. And that's when we would look at selling.
Mm.
You know, borrowing in and over and over and over again to get living money is not going to last forever as we get older.
Yeah.
And that's when we would look at selling.
Yeah, definitely you're going to sell one or two properties to clean up those debt. If you can hold 2 or 3 properties without no mortgage, have a ongoing, consistent, reasonable rent, you know, that's the end game you want to achieve.
That's kind of what we were looking at, yeah. Yes, so we get there. It might change a little bit as the banks change their rules and the government changes its rules.
Yeah.
Well, if you can send that back through, because that is another option that we could see if we can get it. So if we can get the valuations.
Yeah.
And see.
I will do a valuation, and you let the agent know. Agents, all these 3 properties. I won't do valuation for line. I only do valuation for these 3, and then we could decide whether we want to keep. We want to add line, but if we add a line to a picture, there's no problem at all. But we just want to know whether we can just use these 3 properties, and you let the agents know. And we are doing a refinance. The bank, Westpac, may organize a valuation.
Now, previously,
inspection.
When we've done valuations, they contacted me to then to organise with the real estate, and then I just let the real estate know.
Yeah, that's, you can decide. Do you want? I can get the value will contact you. You organize it with them. That's
the way it's been done previously.
Yeah, that's no problem. We can do that. I'll let you facilitate that thing. The first thing, they may decide not to use inspection, rather use computerized modeling
or drive-by.
Yeah, or drive-by. Yeah, you're right.
Just our one that normally has to have an on-site inspection. Our home.
Yeah.
Different.
Yeah. Let's establish the valuation first, and then we decide. At least we know how many properties we are going to use first thing.
Now, are we going to get done in the next 8 days with an application, or when we apply, does it go against our credit score when we do this first? Yeah. Okay. So we got to be careful.
Yeah. The valuation valuation is not just when you submit an application. Yeah, submit the application by 30th June. I mean, we submit the application with the supporting document to the bank. So valuation usually, again, we can start with these three properties, and if we can get a valuation done before, but for us, we need a couple of days for us to package everything as well. So if realistically, for us to launch application by next Wednesday, we need to get everything in place by this Friday. Yeah.
So that's not providing all the backup documentation, is it?
The documentation the most important documentations are, for example, IDs, application form itself, some loan documents and pay slips. Those are easy to get. The Westpac's documentation are quite light.
Okay.
These are 2 pay slips, 3 months bank statement, 3 months loan statement, rental statement. You got all this rental statement already, and I think we've got already about 70 to 80% of the documents already.
Good.
Yeah.
The first MAC statements, as in true statements, are kind of difficult. I'm not sure how we'll get those. I'll probably have to ring them and ask them to send us.
Yeah. We only need 3 months.
But
3 months.
Because they haven't sent us out the next lot, which will be at the end of this month. So they need to send us the documents once every 6 months.
Yeah. Yeah.
So
Okay.
that
Let's.
might be the difficult one. If they don't like the spreadsheet.
Yeah. No. We can't use spreadsheet. I can use, but
Or I can do screenshots of
Yeah, screenshots will be fine.
stuff. I
Do
don't know
screenshot.
exactly, what the screenshots look like now. I can't remember.
Yeah, screenshots is fine. Yeah.
Okay.
Yeah.
So we can probably come up with that. Yep. We've
Yep.
got 2 busy nights ahead of us, Wednesday, Thursday.
Mm-hmm.
We'll talk about it tonight and possibly either leaving Line Street with the bank but with no debt.
Yeah.
Or if we can get it through without leaving it with the bank, all the better.
Yeah.
But if we can't,
Yeah.
because I do want to put them all under P&I eventually, but it was just affordability as well in the meantime to build up more savings buffer. But I do understand, we need to pay down eventually.
Yeah. Yeah. Yeah.
Mm.
I think it's you should pay less interest whenever possible. There's no point just paying higher rate.
Yep. Okay, well, if you want to send that to us, we'll talk.
Yeah. I'll send that to you now.
Yep.
And have a chat with Lisa, and let me know an hour evaluation tomorrow as well.
Mm-hmm.
Today is Tuesday. You are busy on Wednesday, Thursday. But during the day, if you want to give me a call, email, whatever, just let me know. And because for me, we need to prepare loan application as well. So if you say, then let's go ahead, just prepare application. We'll change the loan structure as we go. Let's start this process now. We can do that as well.
You want to send me also what you need for the application if you don't already have it? Okay,
I'll give you a list of information. The majority information, email me your driver's license first. So I have your personal information, date of birth, full name. Then the application itself is quite, there are some information which are not critical, like the home contents worth, vehicles, and there are information for that, but those are not critical information. So usually we just start application with we're putting some dummy numbers, and then you just and we email the whole application with all the details, and then you just tell me what information you want to change. Then we change it accordingly. So you don't need to fill the form. You don't need to give me all the information, asset liability information. Just wasting your time.
Well,
so to keep it simple.
When you send the spreadsheet, just give us a list of what you need immediately to get the application, because we've actually got photocopies of our licenses that have been certified.
Okay, that's good. Yeah, that's handy.
JP. So we've already got that organised. We keep a stack of them ready to go.
So you and Lisa are both Australian citizens, aren't you?
Yes.
Yeah. Okay. Do you have a passport with you as well?
No passports.
Okay. So then I will need a Medicare card.
We've got that certified as well.
Yeah, that's good. That's handy. Yeah. Okay.
Done this
that's
before,
good.
Unfortunately.
Yeah.
Yeah.
Oh,
okay.
by the way, do you have a health insurance policy? Health insurance.
Oh, health. Yes,
yeah,
we've got
private health. Do you remember how much a month?
It's in one of the statements, the expenses. So in the Westpac credit card is paid out. So there's a Bupa and a HIB.
Okay. So those are, for example, if I show you this, where is it here? The calculator. Those are separate living expenses.
Mm-hmm.
Yeah. For example, I put how much I put 100. I put $300 now, so $150 each between you and Lisa. So how much will be? Do you remember?
One of them is 209 and the other's 60 something, but I can't remember if that's fortnightly or monthly.
Okay, so yeah, same, which means probably $300 per month is is close, right?
No, could be double that.
Double that. Ooh.
Could be, yeah.
Oh, so you mean 300? So you mean those are fortnight payment, not monthly?
Want me to find a credit card statement?
Now, if you can pass my phone, I can look it up in the banking there.
That's all right. That's okay. That's okay. I'll go. So you see, this is a non-comparable declared expense is $300 now.
So is that bad?
So it's bad because that will cut into your borrowing capacity.
Okay.
Yeah.
Because we're actually going to get rid of the extras, but that's not the dearer one.
Yeah. Now, but again, you still have about close to 20 grand credit card limit there. We can reduce cost car limit a little bit, whatever. Yeah.
So,
but if we change to if we change to principal plus interest, then we are in a much better position. So we have a 484 surplus.
Yeah. So NIB, which is hospital,
Yeah.
in a fortnight.
Okay. Yeah, that's fine. So we should have a room.
Extras. That's the 8th of this month. So it is close enough to $60 a fortnight.
$6 fortnight, and
So
NIB
210 and 60. So what's that? 270 a fortnight, or
270 fortnight will be 5.
hospital and extras. But we're
Yeah.
going to get rid of the extras because they're not working for us.
Okay. Yeah.
It's a lot of money for not a lot of benefit.
Yeah. True. For about 275 per person. Yeah. Per month per person. It's getting better. I think we can do. Okay. So basically, this is the bottom. That's bare minimum loan, right? So we have about $500 surplus in this kind of situation. We still have a credit card. Just in case, if you do want to keep some loans, keep your cash for your line street. Say if we add $90,000 and see how it goes, it's $49 surplus. So it is possible to keep some of your cash in your hand. It is possible.
Okay.
Right? Yeah.
Well, can we go 50-50 on the line street? So
we can do that. 50. Right? It's $4 surplus. Shortfall. That's a too small. So we can. No. Because if a principal plus interest, there's no interest return anymore. So we go back to surplus again. 137 surplus.
So that's still affordable on this calculator.
Yeah.
And it now changes the repayments. So we do have repayments on the other spreadsheet.
Yeah, but the repayments okay, but because you have more, but you keep $100,000 in your offset account then, rather than lose 200,000, you only lose 100,000. Right. So the repayment, the source of saving is still there. Yeah.
What about that other spreadsheet? If we go and put 50-50 onto line street, that one.
It is here. $50. Oops. Okay. 4,330. It's a PNI.
1,100 something, because that's only $50 a week. That's
yeah. But remember, you have $100,000 cash in your offset account. You retain $100,000. Yeah.
At 140. Hopefully by in a couple of months' time, it'll be 160, 170.
Yeah.
or 270. Yep. Okay. And this is the type of figures we needed to play with.
Yeah,
We can-
exactly. So
we
basically, that's the bottom line, you know. So yeah.
Okay. Well, I think that's
Yeah.
quite possible that.
Yeah.
It still meets our requirements. If we fix another loan or two for a couple of years, that lowers the interest rate as well. Is that a decent lowering
You mean, sorry?
for Benfer? So 33, row 33, column
It's a variable.
N. If we make that fixed.
You want to
What-
fix? Yeah, you can to
Yeah.
fix. Yeah, you can to fix over 2.19%.
Yep.
2.19%. If a 2-year fix.
That didn't change the repayment that much, did it?
Doesn't much. Yeah, not much. About $30, $20 a month.
Hmm.
Yeah.
But that's still half a Benfer. So really that's no use to us.
Yeah. But I think you should put a variable for this 100. So you can start to pay down this $100 to save interest on 100,000. Because you have you want to make use of this offset account balance. You want to sit in there for doing nothing.
Okay. Okay, we'll put that to us and we'll, yeah.
I'll email this worksheet to you. I just simply called it, I think book one something. It's a very book one EXE whatever. Okay, I'll email to you. I'll order valuation for these 3 properties, and
If we're going to leave 100,000 debt on line,
yeah.
we order a valuation on that as well.
Yeah, we can order $700,000 as well. Yeah, yeah. I'll get a valuer to contact you. You can organize the inspection if required. Yeah.
Okay.
Let's do
I
that.
also like to tell them that we're not selling, we're just refinancing.
Yeah, to tell them.
And skip tenants and
Yeah, that's important. Yeah, that's important.
okay, so send us that, order the valuations.
I'll do.
What you need.
And also, also email you some the document, the supporting document checklist. Not just a checklist, it's just a list of the documents you need to prepare.
Yep.
At the same time, but email me your driver's license first. Yeah. So
Okay.
so I can start put a draft application together.
Yep. Okay.
All right.
Sounds good.
Okay. Cool.
Thank you very much for your time.
That's okay. So I like this kind of conversation. You know, it's not just talking about what's the rate. It's find a solution. You know, yeah. So that's yeah.
I think we're in a good position and we are a good proposition to a bank.
Yeah.
We've now just got to make it work to suit us as well.
Yes. Yes. Yeah.
Okay.
Okay. All right. Thank you. Thank you, Anthony.
You're welcome. Thanks, Dennis.
Okay. Thank you. Okay. Bye bye.